Good morning. It is Sunday, July 13th. 81 years ago next Saturday, on July 22nd, 1944, leaders of 44 allied nations were waking up at the historic Grand Mount Washington, New Hampshire. They'd spent a busy few days there, and on that particular day, the effort to create a new post-war economic order would culminate in the signing of an unprecedented agreement, one which would establish for the world of money what World War II established for the world of military power, that the U.S. was the global leader. They all met in the hotel's famous Gold Room to sign the Bretton Woods Agreement and usher in the era of U.S. dominance. It took another 20 years or so, but by the early 1970s, the U.S. dollar had become the de facto currency for all important trade around the world. Many countries pegged their own currencies to the U.S. dollar. All major global commodities, including oil, gold, and produce, are now traded in U.S. dollars. The agreement signed that day in Bretton Woods also created key institutions like the International Monetary Fund and the World Bank to help stabilize the global financial system. Later, my next guest would serve as the chief economist for the International Monetary Fund. Today, the Federal Reserve estimates that in recent decades, the dollar has been involved in about 90% of global foreign exchange transactions and over 70% of trade with Asia alone. The reserve currency status keeps U.S. borrowing costs low. It supports our financial markets. And most importantly, it gives the United States enormous geopolitical power. But today we're witnessing an historic decline in the value of the dollar. Over the past 6 months, the dollar has lost more than 10% of its value against other major currencies, a magnitude of a drop that we have not seen since 1973. Right now, the value of the U.S. dollar against a basket of important global currencies is sitting at a 3-year low. So what does that actually mean when the U.S. dollar drops in value, and why should it matter to us? Well, here's the first thing to know. Regardless of whether you travel or you trade, when the dollar falls, it touches almost every corner of American life, from your wallet to the price of everyday goods, to the government's ability to keep programs running, and even to America's power on the global stage. At home, a weaker dollar makes imports more expensive, and given that we are a major importer, it drives most prices higher. Businesses pay more for raw materials and imported parts, and in most cases, those costs get passed on to a consumer. That means higher prices at the grocery store, at the gas pump, and for countless everyday products. It eats directly into your purchasing power, meaning your paycheck buys less. Now, in fairness, there are some upsides to a lower dollar. A cheaper dollar can make some American exports more competitive abroad, boosting certain industries that export goods and services to other countries. But the bigger picture is more troubling. One big reason the dollar's been sliding is because foreign investors are starting to lose confidence in the U.S. economy, a fundamental loss of faith fueled by ballooning debt, by political dysfunction, and by economic uncertainty driven by President Trump's aggressive, unpredictable, and illogical tariff threats. Simply put, global investors no longer see the U.S. as being as reliable as it once was, and expectations that the U.S. will continue to keep outperforming the rest of the world economically are waning. For decades, foreign investors poured money into American assets generally, and bonds issued by the U.S. Treasury specifically, because they saw U.S. markets as the single safest bet on the entire planet. But now major global investors, and here I am talking about countries and sovereign wealth funds, the biggest of investors, they're starting to look elsewhere. Crucially, the dollar isn't just our currency. It's the globe's currency. The U.S. dollar is referred to as the reserve currency of the world, which is at the heart of our soft power. As foreign policy expert Edward Fishman notes, when the U.S. wanted to put pressure on Iran over its controversial nuclear program back in 2015, it didn't send in troops. It used the power of the dollar to cut Iran off from the world's financial system through secondary sanctions against banks that did business with Iran. That move single-handedly strangled Iran's economy. It forced it to the negotiating table. That kind of financial leverage, rather than military force, has allowed America to shape its global interests without committing American lives. But if the dollar keeps losing value and investors keep moving away, some of that leverage starts to fade. Other currencies, like China's yuan, could potentially slowly start to challenge the dollar's dominance. And if the dollar's role as the world's reserve currency weakens, America risks losing one of its most powerful tools of influence. And then that's no longer just an economic problem. It's a potential national security issue, which brings us back to the U.S. bond market, the true bedrock of America's economic strength. U.S. government bonds, known as treasuries, are backed by the full faith and credit of the United States government, which has never defaulted on its debt. Investors trust that no matter what's happening in the world, wars, recessions, market crashes, the U.S. will keep making its interest payments on time. But recently, Trump's aggressive tariff and erratic trade war fueling economic uncertainty, well, that's caused that faith to start to crack. Foreign investors have begun selling off U.S. treasuries, and that's a bigger warning sign than a sell-off on the stock market. The size of the entire stock market is dwarfed by the bond market, which is also referred to as the debt market. The main difference is when you buy stock, you're an investor in a company. When you buy a bond, you're a lender to a company, or in the case of treasuries, to a country, America. And just like a company that needs to borrow money, if trust in the U.S.'s ability to pay debt erodes, the government is forced to pay a higher interest rate to attract borrowers. And that drives our deficits higher. It leaves less money for critical programs like Social Security and defense. Over time, it can shake the very stability that underpins American economic strength. Now, look, this is not all doom and gloom. The U.S. still has major investment advantages, including a huge liquid financial market and the sheer size of our economy. And for now, there isn't any clear alternative to replace the dollar. But, and this is a big but, history shows that once trust in a currency starts to erode, it is very hard and sometimes impossible to rebuild. Ask the British about the pound. And the shift doesn't happen overnight. It happens slowly. Then, all of a sudden, it compounds. And once that trust is gone, it's not just numbers on a chart that suffer. It is the cost of living, the stability of your retirement savings, the government's ability to keep its promises, and America's place in the world. If global investors lose their confidence in America's ability to honor its financial obligations, it makes it harder for the government to pay its bills. It erodes soft power. In short, the dollar's decline is a warning sign about our economic health, our political stability, and our place in the world. And that makes this more than just an economic story. It's about America's standing and whether we will one day become a footnote in the history of great powers that squandered their strength, undone by the reckless decisions of a would-be king in the White House.